Well, this Hurran will be with you with the U.S. labor market data NFP numbers review and market reactions. Before checking the data, I have to mention that these data are referred to the days or the months before U.S. government shutdown. These data belong to the September. From the October, when the government shutdown starts, October's numbers didn't published, and it's not going to be published. We're going to have the October and November data together later in December 16th. So these numbers are telling us the U.S. labor market condition before U.S. government shutdown. Don't forget that. However, that's going to be the latest NFP numbers, the last NFP number that we will have before next Federal Reserve meeting. Again, I have to say that sorry for my voice. Still, I'm sick and I don't know how long it takes. Still, I cannot breathe normally. So if there's anything disturbing, I mean, if there is anything, any noise in my voice, sorry for that. So let's continue. The data, okay, let's check the data. What the data says, that earnings per hour average, in average increased by 0.2% in September monthly. Annually, it increased by 3.8%. Weekly average working hours increased, was stayed unchanged at 34.2 hours. Unemployment rate increased to 4.4%, but do not forget that participant rate increased to 62.4%, and newly created job, which we say the non-farm payroll NFP, increased by 119, almost 120,000. So we can see while unemployment rate missed the expectation increased, at the same time, we had more newly created job, but why it didn't change? Why still the unemployment rate increased? It's mostly because of participant rate. The participant rate now is higher. So with the higher participant rate, we can see unemployment rate is normal to see increasing while the newly created job also increased. At the same time, we had weekly data. Initial jobless claims increased only 228,000. That's that's much. I mean, that's like much less than market expectations. Jobless claim 4-week average 226,000. It's we can say what the data telling us that it's much less than 250,000 usual average, and we can say that the market is labor market is still strong. Even not this is not very good, but still strong. It's still fine. The continuing jobless claims, which means that the people they applied for unemployment benefits for more than a week, increased to 1,964,000, slightly more than 1,957,000, but still the numbers less is less than 2 millions. And sounds like normal. So the overall data, with the data private non-farm increased by 97,000, and government payrolls increased by 22,000. What generally we can say here that overall data telling us that labor market is fine. We don't have very strong number. We don't have the weak number. I mean, generally the data says that okay, the market is fine. We don't have very good labor market, but at the same time, we don't have a bad labor market. The numbers showing that not, I mean, what the numbers telling us is that we cannot say as a positive, we cannot react as a positive reaction or negative reactions. And at the same time, the data is so old. But generally, the data is fine. I mean, generally, we can say the numbers are fine. That's why we can still see in a FedWatch tools, in the CME Group FedWatch tools that Holding the current rate still has more than 60% chance, while cutting the rate or the rate cut has less than a 40% chance. Just imagine a week ago, it was about 70%. So generally what they can understand from here with this data, market's still counting on holding the current rates more than counting or expecting a rate cut. So checking the market reactions, if we check the charts and see how was the reaction, market's reaction, let me share my chart. We can start from US dollar index. That's a good cool chart. Let's go to dollar index. The dollar index in initial reaction had a negative reaction to that, slightly falling down, but still, it's the initial reaction. And also, don't forget that the dollar index in the last days increased rapidly. So with the sharp increase that we had in recent days, we can expect some correction. But generally, the data, they were not a surprise. So they're not a data that we can say they can change the market direction. So with the some correction, we can say the dollar index is still positive, slightly uptrend tendency. So side movement with slight uptrend tendency, this is what we can expect from the dollar index. Don't forget the dollar index just like a few weeks ago, it was around 97, and now we can see it at about 100. So 100 is so high for now for the dollar index, so we can expect some correction, but still the overall uptrend and overall positive reaction or overall positive tendency is not changing with the numbers that we have. That's why we can say that gold, which reacting to the slightly weaker US dollar and increasing, at the same time, it increased because of the stock markets, because the stock markets now, what the stock market thinks about these data, they are not the data that they can change the Federal Reserve policy makers' mind. That's why in a bigger picture, we can say still the Fed members can vote for holding the current rate as it has more than 60% chance also so far. So the stocks market doesn't like these numbers, doesn't like what's happening here. I mean, the numbers, they are not in favor of the stock markets because we had somehow, we can say it is not a bad number, but it was not a good it was not a so brilliant number, but it was not a bad number or such a weak number that we can say these data can change the Federal Reserve policymakers' mind. Don't forget, now we have GDP grow around between 2.5 and 4% for third quarter and fourth quarter, around 4% GDP growth, while the inflation also is moving around 3%. So inflation is high, GDP growth is acceptable level, is fine. Putting these together, we can say that, okay, these data can tell us that the economy is strong enough to handle the higher rates for a little bit longer. That's why we cannot expect these numbers to change the market tendency or market movement. And we say that, okay, for these numbers, we can say that the Federal Reserve policymakers, they're going to cut their rates or change their policy. That's why these numbers, they are not in favor of the stock market. That can be same for S&P 500, for NASDAQ, and for Dow Jones. At the same time, for the cryptocurrency market, these data are not a positive data for cryptocurrency, while it's not a negative number for the cryptocurrency market as well. Generally, the cryptocurrencies can probably follow the slide movement of the stock market, the weaker movement of stock markets. And now we can say that with these numbers, we cannot expect any change in the cryptocurrencies, especially in the Bitcoin chart. So the overall slight downtrend can continue further. So in short, these numbers, they say us the US stock market is fine, even though it has some cooling signs, but still the US labor market is fine, but it's not as strong. It's fine, it's not as strong. So while the unemployment rate is around 4.3, 4.4%, we shouldn't forget that inflation is around 3%, and GDP growth is fine. The economy is hot. So the Federal Reserve can hold a little bit more before new rates cut. That will be negative generally for the stock markets and somehow positive for the US dollar and bond yields. That was what happened in the US labor market and market reactions. Have a good day. Bye.